So today we are going to be dissecting working capital management. As you know, every business organization, be it large or small, require working capital to be able to function optimally. Working capital is needed for the day-to-day running of the business. Companies will require working capital to pay salaries, right? Acquire raw materials and supplies. Working capital is also needed to settle short-term obligations when the need arises. All right. So the lack of working capital or inadequate working capital can impair the ability of a company to operate on a going concern basis, right? Because if you don't have sufficient working capital to run the affairs of the business on a daily basis, that will limit the ability of the company to function optimally. The operation of the business can be curtailed as a result of that. So that's to tell you the importance of working capital. Even you as an individual, if you lack working capital, in fact, this class, you will not be able to join it, all right? Because you need working capital, you need money to buy data for you to be able to join the class. To attend classes, you need to pay for lecture. So if you don't have the money to pay for your lecture, certainly you won't be able to join. You need money to pay for your exams, right? You need money to pay for exemptions. All these things are what we call working capital. If you don't have cash for you to be able to settle to pay those expenses, certainly life will. We have to manage tonight's class is somehow. I don't understand. Anyway, let's see how the class will go today. All right, so that is basically the introduction to working capital management. Then, what do you understand by working capital? Simply put, working capital represents the difference between current assets and current liability. I repeat, working capital represents the difference between current assets and current liability. Or you can say working capital is the amount required for the day-to-day running of a business. To run a business, you need money to pay salary, you need money to buy supplies, right? You need money to settle short-term obligation as they become due, all right? So these are what we call working capital. Now, there is difference between working capital and working capital management. Working capital management, on the flip side, represents a judicious and efficient management of each component of current asset and current liability, including inventories, accounts receivables, cash, prepayments, and account payable, okay, for the purpose of achieving liquidity, all right, or to ensure liquidity of a business, all right. So working capital management represents a judicious and efficient management of each component of current assets and current liability in order to ensure liquidity. All right, so that is essence of working capital management. The primary purpose of working capital management is to ensure that sufficient cash flows is available. Sufficient cash flow is available to, to pay, to pay for operating costs and settle short-term obligation when the need arises. All right. So this is what we call liquidity. When you have sufficient cash flows, that means you are liquid enough. That's liquidity. Now, what do you understand by working capital management? Sorry, a working capital cycle. The working capital cycle represents the length of time between when cash is paid to acquire raw material and when cash is finally received from debtors through sales. You want to know how long does it take you as an organization to spend money to purchase raw material. You convert the raw material to work in progress. From work in progress will transform to finished goods. Customer will come and buy the products. All right. Customer will buy the finished goods. Of course, customer will certainly pay back in cash, whether they buy on credit or in cash. They are still going to settle you in cash. So you get your money back. Once you get your money back, that means you have completed the cycle. All right. So that is what we are talking about. You want to know the extent or the length of time between when cash is paid to acquire raw material and when cash is received from debtor through sales. That is working capital cycle. The working capital cycle is also known as cash operating cycle, or simply put, operating cycle. All right. And the longer the operating cycle, the longer cash is tied up. Okay, cash is tied up to without any return. You know, when the let's say for example, you spend money to purchase raw material, you have transformed through production, you have transformed all this raw material to finished goods. Then the goods are just there, or maybe customer bought the goods and they are here to pay, and you have not received your money back, and then it's not dragging 3 months, 6 months, you stayed there. So that means your money is tied down somewhere. You can't be liquid in that regard. So when your working capital cycle is longer than necessary, it means that cash will be tied down somewhere without any return. The cash would have even invested in short-term marketable security to earn return. So it's been tied up somewhere. All right. And that is not good. Therefore, company must strive to minimize the working capital cycle by ensuring that the accounts receivable are collected promptly, and at times it may even delay payment to suppliers in order to ensure that you have working capital to operate your business. All right. Now, how do you draw? Because examiner can ask you to explain working capital cycle. So after you have talked about the explanation, so you need to draw a diagram. All right. You need to draw a diagram of working capital cycle. So this is what we are saying. You have spent money to purchase raw material. This raw material, you convert it to work in progress. Okay. You spend cash to purchase raw material. You convert the raw material to work in progress. From the work in progress, okay, you turn into finished goods. Customers will come and buy. Okay, they'll buy the goods. So once they buy the goods, if they pay you in cash, that means you have collected your money. You have collected your money back. If they buy the goods in credit, certainly they are still going to pay you back the cash. Therefore, customer will also settle you. They will return the cash to you. So that is the cycle we are talking about. That is the operating cycle or working capital cycle or cash operating cycle. Now, every business organization, be it large or small, they have to develop a policy or guideline that will dictate how the working capital management of an organization should be done. The policy is intended to manage each component of current asset and current liability. All right. So in order to ensure that the company is liquid enough, and every individual within the organization, every responsible person within the organization must ensure that they comply with the policy. Because, for example, if it's the policy of a company that your your debtors have to pay within 30 days, you must ensure that you monitor and you collect your receivables as and when due. All right. Before the due date, you have to send a reminder to your customers that, okay, this payment will be due in the next 5 days, for example. So you keep on pushing it to ensure that you collect your money as at when due, because once it has passed due, then certainly it will become a problem for the business because you need that working capital to be able to run optimally. All right. So how do you then estimate working capital cycle. How do you calculate working capital cycle? There are 5 different components of working capital cycle. All right. There are 5 components of working capital cycle. Before we talk about how to estimate, let me show you the format. It's not here. Let me find somewhere and put it down. All right. So if you want to calculate working capital cycle, so you come here, calculating working capital cycle. Let me shorten it. So the working capital cycle is expressed in days. All right, it's expressed in days. Therefore, the first item, depending on the information given in the question, it's not compulsory that you are going to have the entire 5 components of working capital cycle in a question. At times, examiner may give you only 3, 2, 4, or the entire 5. Whichever one that is given to you is what you are going to compute for. Therefore, the first item under the working capital cycle or operating cycle is number of days raw material is held in store before going into production. All right, so you can see, you can come here, number of days, raw material is held in store. Whatever you have calculated, come and put it here. Then the second one is number of days, work in progress, or just say the length of time in the production cycle, length of time in production cycle. So put it there. Then the third one is number of days finished goods is held in store before being sold. Then number 4, you need to determine number of days credit is given to customers. Number of days credit is given to customers. So then you add up the 4 line items. This will give you gross working capital cycle. After the gross working capital cycle, you consider number of days credit is taken from supplier. All right, so you less whatever you have thereafter represent the net working capital cycle. So this is the format for calculating the working capital cycle. Now, to now calculate the number of days raw material is held in store before going to production. When you want to calculate your raw material conversion period, when you say number of days raw material is held in store before going to production, what we are saying is raw material conversion period. How long does it take you to convert raw material to work in progress? All right, so that is the raw material conversion period. So this is calculated as raw material divided by purchases multiplied by 365 days. So in a question, examiner can tell you to assume 365 days or 360 days. In most cases, examiner will be silent. That means you are at a liberty to either assume 365 or 360 days. Whatever day that you have assumed for a year, so you need to indicate it in your answer booklet. Okay, so then once you are done with your raw material conversion period, you go and post. The second one is work in progress conversion period, which is the length of time in the production cycle. To calculate this, it is work in progress divided by cost of sales or cost of goods sold multiplied by 365 days. Again, the third one is finished goods conversion period, which is the number of days finished goods are held in store before being sold. All right. So in this case, to calculate that, it is finished goods divided by cost of sales. Then the fourth one is debtors collection period or debtors conversion period, which represent the number of days credit is given to customers. So this is calculated as debtors divided by credit sales. All right. So again, in a question, examiner may tell you that, okay, out of the sales, let's say we have sales of 10,000 naira. Examiner can tell you that 20% of sales are on credit. 20% of sales are on credit. So, sorry, are on cash. If 20% is cash, so it means that 80% is on credit. But in most cases, examiner will just be silent. If examiner is silent, that means you are going to assume that the total sales is on credit. All right. So that is as per that. The last one is creditors payment period, which represent number of days credit is taken from suppliers, and it is computed as creditors divided by credit purchase. So like I said, if in a question you are not told whether the sales or purchases are on credit, that means you are going to assume they are on credit. All right. So once you are done with all these formulas, they are for workings. Once you are done with your workings, then you go and post in the formats. So once you are done with your raw material conversion period, you post. Work in progress conversion period, you post. Number of days, finished goods conversion period, you post, and then the creditors collection period or debtors collection period or debtors conversion period, you post. You have the gross working capital, then you less creditors payment period. So whatever you have is your net working capital cycle or operating cycle. This is how to estimate operating cycle. This is how to estimate operating cycle. I would have loved to let's solve illustration, but let's talk about working capital ratio before we move to illustration. Okay, let's solve. Let me look for a space to talk about that. I'll just mention it. Let me look for a space. Yeah. Now, when you talk about working capital ratio, okay? Let me use this other space here. Working capital ratio. All right. The working capital ratio are the matrix designed to ascertain the liquidity position of an organization. All right. Their working capital ratio are the matrix designed to ascertain the liquidity position of an organization. The components of working capital ratio include one, current ratio, then two, liquid ratio, then three, we have working capital turnover ratio or sales to working capital ratio. You can call it sales to working capital ratio, sales to working capital ratio, or you simply call it working capital turnover ratio. So these are the components of working capital ratio. I believe Mr. Asiwaju has taught you, or Mr. Wasiu Opola in financial reporting has taught you financial statement analysis. So you would have learned about current ratio, liquid ratio. But let me just touch base. Let me just comment on each one of them. When you talk about current ratio is simply the ratio that establishes the relationship between current asset and then current liability. It is computed as the ratio of current assets over current liability. So it's one of the ratio of determining the liquidity position of an organization. So to calculate the current ratio, all right, current ratio, we said, is the ratio of current assets over current liability. Current assets over current liability. So that is how to compute the current ratio. When you compute your current ratio, it's not sufficient. You need to comment, you need to interpret your results. How do you interpret your results? Your current ratio, whether the ratio you have computed is ideal, will depend on the industry, because the current ratio, the ideal current ratio will vary from industry to industry. But generally, worldwide, the ratio between 1.5, the ratio between 1.5 to 3 is assumed to be ideal, right? The ratio between 1.5 to 3 is assumed to be ideal. If it is more than 3, that is too excessive. That is excessive. All right, that's over investments in current assets, which is not good. All right, so ratio of 1.5 to 3 is ideal. In some texts, you may see it as average industry standard is 2.1. All right, say ratio 2 to 1, rather ratio 2 to 1. But again, like I said, this ratio varies across industries. It's not constant. It's not the same thing across different industries. So, but the ratio between 1.5 to 3 is assumed to be ideal for any organization. All right. So that is current ratio. Then we talk about the liquid ratio. Liquid ratio is also known as acid test or quick ratio. All right. It's also one of the ratios that is used to determine the liquidity position of an organization. The liquid ratio uses is a more kind of a conservative ratio, such that it only consider the liquid assets of an organization for the purpose of determining the liquidity position. So meaning that anytime you want to compute the acid test ratio or liquid ratio, whenever you want to calculate liquid ratio, the liquid ratio is the ratio of current assets less inventory over current liability. All right, is the ratio of the liquid assets over current liability. All right, because inventory is deducted from current asset. Whenever you want to calculate your asset test ratio, you don't include inventory, because inventory cannot be easily converted to cash. It's not, in most cases, inventory can last for days, for months before being sold to generate revenue. And that's why you don't consider inventory as part of liquid assets. So to calculate your liquidity ratio, you pick your current assets, you less inventories, then of course you divide it by current liability. Divided by current liability. So that will give you the acid test ratio or quick ratio or liquid ratio. So that is how to do that. The last one is sales to working capital ratio. All right. Sales to working capital ratio. The sales to working capital ratio is the ratio of net sales. Is the ratio of net sales to working capital. It is also known as working capital turnover ratio. All right, let me put it there. Sales to working capital ratio. Working capital ratio. So it is computed as the ratio of net sales over working capital. you want to know how many times does working capital, how many times does the sales cover the working capital, or how much contribution as working capital makes to generate sales. Now, when you talk about net sales, at times when customers buy your products, it is possible they may return after they have paid. They may come back and return some, or maybe due to defect or whatever any reason. All right. So once they return some of the goods, so that will give you sales return. It is also possible a company may give a discount to customers, so that means the customer will pay less. So in this case, you need to deduct it from your sales. Therefore, net sales is computed as sales minus sales return and discounts plus discounts, sales return plus discounts. So that will give you the net sales. Okay. So when you do that, you have your net sales. Then you go and calculate your working capital. And you know that working capital is current asset minus current liability. So that is basically that. Again, what is the standard of your working capital turnover ratio? What is the standard of your working capital turnover ratio? So if you have ratio 3 to 1, it's okay. If your sales can cover your working capital like 3 times, that's okay. Ratio 3 to 1 is ideal. When you have more than 3, ratio 3 to 1, that means you're having excessive. That means that you don't have sufficient working capital to run. That's the implication. You don't have sufficient working capital to run the business. That's why you have excessive working capital turnover ratio. But if the ratio is low, if your working capital turnover ratio is low, it means that the company is not making enough sales. The company is not generating sufficient sales. All right. It's not generating sufficient sales. In this case, you need to embark on aggressive marketing to promote the business in order to generate sales. Okay. It may also be that you have over-invested in working capital. When you have a low working capital turnover ratio, it may well be that the company has over-invested in working capital. So that is not good. When you have excessive working capital, it's not a good working capital management, because those funds would have been invested in short-term marketable securities to generate additional return to the business, but you are tying it down in working capital. Your current asset is so huge, your current liability is low. So in this case, you have excessive working capital. That is what is known as under trading. All right, that's what is known as under trading. So when this happens, of course, your working capital turnover ratio will be very low. All right, so that is basically that. Now, at this point, let's have illustration. Let's have illustrations. Let me see. Let me see. We're coming back to other ones later on. Let's have illustration to test the working capital cycle. All right. Let's have illustration on that working capital cycle. Okay. Um, Let me see. Let me see. All right. Let me see this one. Which one is this? Okay. All right. Let's solve this illustration number 6. Let's solve this illustration number 6. Uh, Let me see. Let's see if I can get another one. Okay. Uh, okay. Let's solve this one that has three different years. Let's start with this one, illustration number 11. Yes. let me see. Let me call one of you to read for us. Again, Angela is not in this class. Last time she did not attend my class. I think she has missed 2 classes now. I hope she's fine. Angela, are you there? Can you hear me? I can't see your name. Anyway, all right. Yes, Ada, read for us, please.
Okay. Good evening.
Illustration 11. Good evening. How are you?
Okay, fine. Okay. The working capital cycle of a business is the length of time between payment for inventory entering into inventory and receipt of the proceeds of sales. The table below gives information extracted from the statement of comprehensive income and the statement of financial position of Ballerina PLC for the years 2012 to 2014. Informations are given below. You're required to A, calculate the working capital cycle for each of the 3 years. B, explain 3 possible actions that might be taken to reduce the length of cycle and 2 possible disadvantages of each.
All right. Thank you, Ada. So, examiner is asking you to compute working capital cycle for each of the 3 years. All right. Now, when I was explaining, I can't remember if I mentioned that, when I was giving you the formula for calculating operating cycle, all those components, for example, raw material, examiner can ask you to use average figure. All right. Examiner can ask you to use average figure. That means you are going to add together to get the average figure, you add the opening plus closing figures. Then you divide it by 2. That will give you the average figure. For example, if you want to calculate, if in the question you are given, examiner is asking you to use average figure. So you are going to pick opening raw material, you add closing raw material, then you divide it by 2. Opening work in progress plus closing work in progress, you divide it by 2 to get the average. Closing finished goods plus opening finished goods divided by 2. Closing even debtors plus opening debtors divided by 2. So that's how you are going to do for all of them to get the average figure. But again, if examiner did not ask you to use average figure, so you are going to, the question is silent. So just do it the way you understand. Don't need to be doing average. If you are not asked to do average, don't use average figure. All right. So if that is the case, to solve this question, what are we supposed to do? First thing first, you need to go back to the question and identify if you have all the 5 components that you need to calculate your working capital cycle. So to get your working capital cycle, you are going to need raw material, work in progress, finished goods, you need receivables, and you also need payables. So the 5 of them are present in this question. Therefore, let's stop sharing this and move to the working notes straight. Okay, this is solution to illustration number, I think that's illustration 11, page 114. So solution to illustration 11, page 114. All right, the name of the company is Ballerina PLC. So you want to calculate, you are asked to calculate working capital cycle. So I would then say number A, calculating working capital cycle. All right. So since we have the entire 5 in this question, so let's design our table. So the first item will be number of days raw material is held in store, or you can say raw material conversion period. You are still saying the same thing. So I can say raw material conversion period or number of days raw material is held. So let's use number of days raw material is held in store. So we go and do working for that. The second one is the length of time. Length of time in the production cycle. All right. Length of time in the production cycle. That's work in progress conversion period. All right. Then we determine number of days. Finished goods ahead in store before being sold. You know, when you finish production, you are going to keep it in the warehouse. So when you want to go to the market to sell, you go to the warehouse and pick the goods there. But you want to know how many days does the finished goods stay in the warehouse before being sold. Then we need to calculate number of days. Credits is given to customers. All right. Then you are going to have the gross working capital cycle. After the gross working capital cycle, then you less the number of days credits is given to customer. So the number of days credits is taken from supplier. All right. When you less, then you are going to have the net working capital. Oh, I did not give enough space because this is for 3 different years. I have to go back again. This is for 3 years. So in that case, let me just use the one that will be faster for me. All right, I've already wasted time writing all of this. So first thing first, let me just do it this way. Here is 2012, 2013, and then 2014. All right. That's, 2012, 2013, then 2014. So this is expressed in days. All right. So let me shorten it because we've wasted time. So this is raw material conversion period, work in progress conversion period, finished goods conversion period, debtors conversion period. We have the gross working capital cycle, gross working capital cycle. All right, capital cycle. Then you less creditors payment period. So that will give you the net working capital cycle. Okay. So let's manage this like this. So this one will come like this. Okay. This is the final answer. Also, you add up all of this to have the gross working capital. So this is the format. So we then need to go and do workings for each of them. You need to go and calculate for each of them. So let's start with raw material conversion period. I would have chosen a simpler one though. that has the one that have only one year instead of 3. But in any case, I've taken it. Let's move on. So I will do column for 2012. This is workings. If you calculate operating cycle or working capital cycle without showing your workings, that means you have derived somewhere, you have gotten it somewhere, because there's no way you can't do it on your head. You have to show your workings. So examiner will assume that maybe you take the answer from somewhere. And that's why you have to show your workings. So here is 2012, 2013, then 2014. All right. So we want to compute for starting from raw material conversion period. We said this is raw material divided by purchases. Raw material purchases multiplied by 365 days. Examiner did not tell us to use either 365 or 360 days in the question, so you are at liberty to choose any one. So go back to the question. In 2012, what is raw material, the value of raw material in 2012? Give it to me.
1,080 naira.
1,080. 1,080. Here is 1080 divided by, what is purchases? How much is purchases?
5,184.
5184. 5184. Therefore, multiply by 365. Give it to me. What do you have? 1080 divided by 5184 equal, multiply by 365. What you get?
5 points.
5.50 what?
76.04.
76 days. That's 76 days. Then in 2013, how much is raw material?
1458.
1458 divided by purchases.
7020.
7020 multiplied by 365. What do you have?
75.8.
76 days. Then in 2014, how much is raw material?
1,800.
1,800 over purchases.
7,200.
Okay, multiply by 365 days. What do you have?
91.5.
Pardon?
91.25.
91.25, that's 91 days. So we then need to go and post. All right, so you don't need to wait until you finish all your working before you post, because time may not permit you. Anyone you have computed, quickly go and post it. So here is 76 days, 76, then 91. The next one is work in progress conversion period. All right, working number 2. This is 1. So I can close this. So working number 2. is work in progress conversion period, which is equal to work in progress divided by cost of sales. Cost of sales multiplied by 365 days. So in 2012, how much is work in progress?
756.
756 over cost of sales.
7560.
7560 multiplied by 365 days.
36.5.
76.5, that's 77.
36.5.
36.5, 37 days. Then in 2013, how much is work in progress?
972.
972 over cost of sales.
9720.
9720 multiplied by 365 days. What you get?
36.5.
That's 37 days. In 2014, how much is work in progress?
933.
933. Then cost of sales.
10,983.
983 multiplied by 365 days. What do you have?
31. 31 days.
31 days. So we need to go and post. All right. So work in progress conversion period is 37, 37, and then 31. The next one is finished goods conversion period. Finished goods conversion period, number 3. So let's close this number 2. Then moving to number 3. Finished goods conversion period, which is equal to finished goods divided by cost of sales multiplied by 365 days. So in 2012, how much is finished goods?
864.
864. 864 over cost of sales of 7560 multiplied by 365 days. Give it to me. What do you have?
41.7.
That's
41.7.
42 days. 42 days. 2013, how much is finished goods?
1296.
1296 divided by 9720 multiplied by 365 days. So what do you have?
48.6.
That's 49 days. In 2014, how much is finished goods?
1428.
1428 divided by cost of sales of 10,983. Then multiply by 365 days.
47.5.
47,
0.5.
that's 48 days. All right, so let's go and post. 42, 49, 48. 42, 49, 48 days. Then the next one is debtors conversion period or debtors collection period. Number 4. debtors conversion period equal to debtors divided by credit sales multiplied by 365 days. In 2012, how much is the debtors?
1728.
1728. How much is sales in the question?
8640.
8640 multiplied by 365. So since examiner did not tell us in the question whether sales is part of the sales is cash, so as the question is silent, so you are going to assume the entire sales is on credit. So give it to me. What do you have?
73.
73 days. In 2013, how much is sales? Sorry, debtors.
2592.
2592. Credit sales.
10,800.
10,800 multiplied by 365 days. So what do we have?
87.6.
That's 87 days. Then in 2014, how much was debtor?
2970.
2970 over credit sales.
11,880.
880 multiplied by 365 days.
Excuse me, sir.
Yes?
That's 2013. Is it not 88 days?
Okay, I said
Okay. 87 points.
86.
Okay, that's 88 days. Error of mind. Oh, yeah. Thank you for that.
91.25.
Yeah, what's your answer here? 31.
91.3. 91.3.
Okay, that's 91. Again, we need to go and post. So we have 73, 88, 91. 73, 88, then 91. So let's add up. Let's add up the four. Add up for each year. What do you have?
For 2012,
Yes,
228.
228.
2014.
Yep.
260.
Two what?
2014. 260.
Okay.
2013, 250.
250. So we then less creditors payment period. So let's go and work it out. Number 5. Number 5, creditors payment period, which is creditors divided by credits purchase. Credit purchases multiplied by 365. So in 2012, how much was creditor?
864.
864 divided by purchases.
5184.
5184. Then multiply by 365. What do you have?
60.8.
That's 61. 2013, how much is creditor?
1053.
1053 over credit purchases.
7020.
7020 multiplied by 365 days. So what do you have?
54.8.
That's 55. Then in 2014, how much is creditor?
1260.
1260 over credit purchases
7,200.
multiplied by 365 days.
63.8.
64 days. So 61, 55, then 64. Let's go and post. Here is 61 minus 55 minus, and then 64 minus. What's the difference?
2012. 167.
167.
2014, 196.
196.
2013. 195.
195. All right. So that means on the average, it takes this company almost 180 days. Let me confirm that. We have 167 plus 195 plus 196 equal, that's 558 divided by 3. So it took the company average of 186 days to recover the money spent to purchase raw material. Well, we can't say if this is ideal, depending on the industry average. All right, since we don't have industry average, so we cannot compare. However, we can see the trend between 2012 and 2014. We can see the trend between 2012 and 20. Please help me verify. I think 2014 is wrong. What do you mean? Which one is wrong? Speak up, Laura.
The total, I think, is 261 minus 64. That's 197.
260 minus 64.
261. The total is supposed to be 261.
Okay.
I don't know.
91 plus 31. Yeah, 112. Okay, it's possible. All right. So I think so. This one's supposed to be 261. So this one will be 19 what? Or maybe I'm the one, maybe one of these ones is not correct then. I think 260 is the right answer. Let me confirm.
Yes,
Uh,
the approximation, there is approximation issue there.
which one?
That's 48, supposed to be 47.
So what's okay, this number 3. So maybe this one's supposed to be, yeah, let's do it together again. Okay, let me carry my calculator. 1428 divided by 10, 983 equal, then multiply by 365 equal that, 47.45. This is supposed to be 47. Okay, so that's why, yeah, Laura is correct again. So but this one's supposed to be 47, then 260. So the final answer is correct. All right, thank you, everyone. So let's move on. Now, so you took the company average of 186 days to recover the cash spent to purchase raw material. This is, we can't say this is an ideal working capital cycle until you're able to compare with the industry standard. However, when you look at the trend between 2012 and 2014, you will notice that the situation is getting worse for this company. In 2012, it takes the company, it took the company 167 days to recover the cash spent to purchase raw material. But between 2013 and 2014, almost 185 days, all right? 185 days on the average between those 2 years, which is not good enough. All right, it's taking longer. The company is taking longer to receive, to recover the amount spent to purchase raw material, which means that capital is tying down. Capital is tying up somewhere. The money you could have spent or you could have invested in short-term marketable security to earn returns is being tied down somewhere, which is not good. All right. So when you look at this, you will notice that to confirm your position, when you look at the debtors collection period, it takes the company 73 days in 2013. The company gives credit of it takes the company 73 days to recover the money the customers are owing to it. 88 days in 2013, 91 days is even getting worse, getting longer. Meanwhile, it takes the company 61 days to pay back. The credit is owing to the suppliers. It takes the company 61 days in 2012 to pay back the supplier, 55 days in 2013, and 64 days in 2014. So the company is paying back the amount owing to the supplier earlier than what customers are paying back, which is not good. You are supposed to even delay payment to your creditors, to your creditors, suppliers, so that you can use that money to manage your business as working capital. But the reverse is the case here. This is not a good working capital management. All right. So examiner is now asking you in the C part of the question. Let's go back to the C. Sorry, number B. In the B part of the question, you are asked to explain three possible actions that might be taken to reduce the length of the cycle and 2 possible disadvantages of each. 6 marks. So what are the possible actions that can be taken to reduce the length of the cycle and 2 possible disadvantages of each actions that you have identified? All right, let's talk about that briefly. The first one, you can see number B, the possible actions that can be taken to reduce the length of the working capital cycle and their disadvantages include the following. Number one, you talk about raw material. Okay, you talk about raw material. How do you reduce the length of the raw material conversion cycle? When you go to the question in our calculation, it took the company 76 days to convert raw material to work in progress and 91 days in 2014. How do we reduce the raw material conversion period? Several actions can be taken. Instead of a company can adopt just-in-time system. You don't need to purchase too much of raw material. You can adopt just-in-time system so that what you need is what you are buying. So you buy only what you need at that moment. That's just in time. So that will reduce the raw material you have kept in the warehouse. All right. And this will also reduce the raw material conversion period. All right. So the company can also reduce the raw material required to produce. Okay. Or reduce the safety stock. What are the disadvantages that can arise if you reduce the quantity of the raw material? What are the disadvantages that can arise? Number one disadvantage is there will be possibility of stock out, because if you don't buy sufficient raw material, when you are into production cycle, it is possible you may be out of stock. When you are out of stock, then there will be no smooth production run. The production activity can be disrupted as a result of that. So, and that's what we are saying here. There will be possibility of stock outs once your stock finishes. That means you have to stop production and wait until you get material again, which is not good. Again, if you reduce the quantity of your raw material, another disadvantage is that it will increase your ordering cost. Ordering cost is the cost incurred whenever a company places an order and when the order is finally received. For example, when you want to buy material, you are going to make call to your supplier. See, I need so much quantity of this material. From that point, you started making the call. You have been incurring the ordering cost. So because you are not buying in large quantity, you are buying in bits. So that means every time you are going to the market to buy, so that means your cost of transportation will increase because you go and buy small. When that one finishes, you go again and buy. So in that case, your ordering cost will increase. So that's one of the disadvantages also. Like I said, it will disrupt production run because once there is a stock out, there will be disruption in the production run. So these are some of the disadvantages of reducing or of buying reduced materials. Okay. Then another possible action that can be taken to reduce working capital, work in progress. Okay. To reduce work in progress is to introduce advanced model machine, which has the capacity to produce high quality, large volume, and also bring about efficiency in production. Okay, to reduce the number of time in the production cycle, you need to introduce or you need to buy advanced model machine that have the capacity to produce better and high quality products, and that will also bring about efficiency in production because the existing machine may be giving the companies a problem, and that's why they are taking longer. They are taking longer in the production cycle. So as a result, to address that issue, you buy advanced model machine that have the capacity to produce better, high volume, and also result in efficiency in production. What are the disadvantages to be considered? One of the disadvantages is that, of course, for you to be able to buy the machine, that means you need capital. You need money to go and purchase the material, to purchase the machine. Therefore, capital expenditure will be required to purchase the new advanced model machine. When you buy the machine, all right, you need to train the staff that will be operating the machine so that it doesn't result to any incidents, accidents or injury. So you need to train the people that will be operating the machine. So the cost of training and installation of the new technology is also a disadvantage, all right, because it will require cost. It will require cost. Then number three, how do you reduce finished goods conversion period? To reduce the finished good conversion period, of course, reduction in raw material. Once you reduce the raw material and work in progress, of course, it will reduce the finished goods because the raw material and work in progress, they are they are the results. The finished good is the result of the raw material and work in progress. So once your raw material reduces, your work in progress also reduce, then finished goods will reduce. But what are the likely disadvantages to experience if you reduce the finished goods conversion period? Of course, again, you may have loss of revenue. You may have loss of revenue. Then you may also have loss of customer. You may lose some customers to competitors. You may lose some customers to competitors when there is a stock out. All right. So these are some of the disadvantages under the finished good conversion period. Then number four, how do you reduce the trade receivables? How do you reduce the receivables? To do this could be achieved by offering cash discounts. Okay, you can offer cash discounts. You give you tell the customer, so if they are able to pay cash immediately, then you give them a discount. So that will enable them to pay cash immediately. So instead of them to be owing you, you have already collected your money, like Equity Professional did when the diet was when we resumed the diet. Equity Professional says, okay, to reduce my my receivables, okay, let's give some student, let's give the student, all the student, let's give them a credit, a discount of 10% if you're able to pay your full lecture fee, all right, between few between a week or thereabout, okay, you will enjoy 10% discount. Some of the students take advantage of that opportunity. All right. So when you do that, that will enable you to have a cash flow to run your business. Okay. Not only that, the company can also reduce to reduce the uh, debtors or receivables or debtors collection period. The company can review the credit terms. Maybe the company has a liberal kind of credit terms. You need to tighten it. You need to tighten up so that you allow the customer to pay quicker. When you tighten up, that means you don't want to give customer. Maybe you are giving them 30 days before to pay. You can reduce it to 15 days. That means you have tightened it. So you need to review the credit terms. So that will reduce the cycle. All right. Then you can also engage the service of a factor, all right, or debtor collection agent. You can engage the service of a factor or debtor or debt collection agent. When you say a factor is a company. For example, if a customer is owing you, you have a receivable from a customer, let's say 1 million naira. So, and the customer say it will pay in the next 1 month or thereabouts, and you need cash, you cannot wait for the next 1 month. All you need to do is to engage a debt factor, right? That debt you are going to sell the receivable. You sell it to the debt factor at a discount. So it is the debt factor that will be pursuing, that will be chasing the customer. So you have already collected your money. Maybe, of course, that's 1 million naira. Maybe you have sold it to the factor at a discount of 10%. That means you are going to receive 90%, which is 900,000 naira of the 1 million. The remaining 100,000. So that's for the service of the that's for the debt factor. So going forward, you don't have anything to do with the customer. It's the factor that will be chasing the customers to ensure that the money or the receivable is collected. All right. So what are the disadvantages owing to that? Number one, the cost of the discounts, because you've already sold the goods to the customer out of 1 million. Now you are collecting 900,000. That means you are losing 100,000. So of course, you need to consider that if something you can bear, no problem. Then the possibility of the customer, it's possible that the customer may take the discounts and they will not even pay on time. Okay, they won't pay on time. So that means if the company has a kind of a weak system, so it is possible. Because I can't imagine if I give you a discount of 10%, I expect you to pay immediately before you even take the goods. All right. So you can't take away the goods without paying since you've already enjoyed a discount. Okay. Now, what about the cost of collection in case of a factor? Again, so loss of sales, the customer may not come back to you again if you engage the service of a factor. The customer may feel embarrassed. Why did you have to introduce me to another company that will be collecting debt on your behalf? It's an insult, it's an embarrassment. I won't patronize you again. So the company may lose sales, may lose patronage as a result of that. But if it's something that you want to do, yeah, you can go ahead. If it's something that you can bear that, okay, if this customer does not come back again, no worries, another customer will come. All right. So those are the things you need to talk about under how to reduce your trade receivables. And the last one, how do you reduce your creditors payment period? How do you reduce your payables? All right. To do this, of course, payment to supplier or colleagues could be delayed. So if you want to reduce, of course, if you want to, in this case, you don't reduce your creditors payment period. Rather, you are going to increase it. You are going to when you delay payments, if you are supposed to pay to your supplier in 15 days, in 2 weeks time, you can delay it to a month. But that may impair your credit worthiness with the supplier. The supplier may not like that, but you need to engage. If you want to delay payment to the supplier, you need to engage the supplier. You need to inform the supplier on time that, see, we are having these challenges. Please give us more time to make our payment. So if there's understanding between the two parties, there will be no issue. But when you do it intentionally, when you delay payment to suppliers intentionally, that may erode the confidence that the supplier has in you, or you may not have you may not be a kind of credit worthy to the supplier going forward. So what are the disadvantages? Supplier may refuse to supply you in the future. All right. The supplier may refuse to give you goods in the future. So instead of giving on credit, that means they will ask you to pay on cash. That's another way. Supplier may only supply to you on cash basis. If you don't pay cash, that means you are not ready to buy. Okay. Again, this may result to loss of reputation. So the supplier will see you as not being credit worthy. Therefore, they won't give you goods again because you always delay payment, and which is not good. And that's why some of you that are still owing equity professional lecture fee since July that will resume. Some of you are still paying some part payment, which is not good. You can imagine. Look at the stress we are going through. Look at the stress we are going through to buy data and then to engage you online every now and then. Some people will still be delaying our payments since July that we resume class. It's not that we cannot take action on that, but we just say, okay, let's engage, let's allow these students to learn so that we don't prevent them from joining the class. But some of you are not taking that advantage. You are taking us as a fool, which is not good. We can write to ICAN. Yes, we have your details. We can write to ICAN and we are going to collect our money. Without even writing to ICAN, we collect our money. Some of you even stop without telling us that, oh, I've not been coming to class due to this or that. When you ask you for their payment, you said, oh, okay, you don't see me. Do you see me in the class? Some of you will even be insulting us, just because we're asking for our pay. That means you are not credit worthy. So you are going to deny others that opportunity tomorrow. That's the implication. If tomorrow now you want to join the class, we will say, okay, you must pay 100% before you join the class because we know that you are not credit worthy. So this is what we are saying. All right. Even supplier, in this case, even if I'm going to give you that credit, I have to increase the price. I will increase the price in the future. So these are the things, these are the disadvantages of if you are trying to reduce or to increase creditors payment period. These are the challenges you need to consider. All right. So that's end of the question. Let's have one more. Let's have one more under the creditors, under the working capital cycle. Let's have a question that involve working capital ratio. Any question for me? Any question for me? All right. If there's no question, let's move on. Let me stop sharing and move to.
Excuse me, sir.
Yes.
Sorry, please. The disadvantages you just like the big question, the number B. Please, can you put it in writing and send to the group, sir? Please.
I can't put it in writing. It's already late, You want me to be listing all of that one by one since? No.
Okay.
You listen to the video. You listen to the video. You write it down when you listen. All right. No
Okay,
time.
sir. Okay.
We have only two more lectures now. Monday, next Saturday, and then let me making three. So we see even this working capital we are treating, we need about 3 periods. Business valuation and additional 3 periods. We have only 3 periods left. So in fact, all this talking I'm talking is too much because we don't have time at all. Anyways, let's move on. All right. Let me share my screen. Okay. Now, let's have one more illustration under this. Let's have a question um that involve working capital ratio. Let's have a question that involve working capital ratio. Let me see. Okay, that's it. Let's have illustration number 8. Yes, who is helping us to read? Illustration number 8. Yeah. Ogechi. Oh yeah, read on. Okay.
Okay, sir. Illustration 8. List 5 relevant factors that determine the working capital requirements of a firm. And then the B part, the management of Ayetoro Nigeria PLC desires to review their working capital management policy and has presented the data stated below to you as the newly employed management accountant. In order to assist in taking a meaningful decision, the following data were given. Current assets, stock, raw material, 21.6, debtors, 32M, and then cash, 40,000, total of 53.640. Current liabilities, we have creditors, 10.80,000. Purchases during the year were okay, 1,500,120,000, and sales were 168. You are required to calculate sales slash working capital ratio, current ratio, quick ratio, or acid test ratio, the operating cycle for the working capital.
Yeah, thank you. Okay, yes, that is the question. The first one says you should calculate sales to working capital ratio. Let me stop sharing this. Sales to working capital ratio. That is illustration. Let me scroll down. This is solution to illustration. I think that's illustration number 8. Let me confirm.
Page
Yes,
112.
illustration number 8, page 112. Illustration 8, page 112. All right. So the name of this company, number A part of the question, examiner is asking you, examiner is asking in the A part of the question, you can mute, please. Okay, mute. So in the A part of the question, examiner is asking you to list 5 relevant factors that determine the working capital requirement of a firm. All right. So what are the criterias? What are the factors? What are the determinants of working capital requirements? That's what the examiner is asking you. Okay, what are those factors you must consider before you can say this is how much of working capital that I need? That is what the examiner is asking you. All right. So factors to consider in working capital requirements. Okay. What are those factors? One, you can talk about the credit terms of the company. You can talk about companies' credit terms. Then two, you can talk about suppliers' credit policy. Number three, you can talk about the nature and size of the business. Nature and size of the business. Number four, you can talk about inflation, price level changes. Number five, you can talk about seasonal variation or seasonality. seasonality. Number 6, you can talk about economic condition. Okay, you can talk about the economic condition. Economic condition. Now, let's talk about the first one, which talk about credit terms. All right. If a company has, remember, what we want to do is to determine the factors to consider in working capital requirement. What are those determinants you need to consider in working capital requirement? We said credit term, company's credit term. If the company has a strict credit terms or credit policy, if the company has a strict credit policy, that means that customer will be paying quicker. Customers will be paying quicker. So as a result, we are going to have enough working capital. But if the company has a loose or a liberal kind of credit policy, many customers will be owing. As a result, we are going to need more working capital for your operation. So the credit policy of the company will determine the the amount of working capital required for the business. The second one is supplier's credit policy. So if your supplier give you a stricter credit terms, that means you need to pay quicker to your supplier, which will deny, which will impair your ability to get materials for your production. So that means you need to pay on time. You need to pay quicker to your suppliers. But if your supplier have a good or a liberal credit terms, so that will afford you the opportunity to delay payments to the supplier. That means you don't need much of your working capital during that time. But if your supplier has a tighter or a stricter credit policy, that means you are going to need more working capital. Okay, you are going to need more working capital. The other one is nature and size of the business. Businesses operates in different sector. For example, the working capital requirement of a manufacturing company will be different from a service company, all right? Because a manufacturing company will need inventory, all right? Whereas a service company does not need anything like inventory. So the amount of working capital required by a manufacturer is different from a service company. So and then not only that, the size of the business will also depend on the level of the amount of working capital required. For example, in our own industry, in the education where we operate, Equity Professional, we have centers in Lagos. Oh, sorry, we have two centers in Lagos, one in VI, one in Isolo. We also have online. The amount we are going to pay to our lecturers will be different relative to a tuition center that has only one physical class, right? That means we are going to need more money to pay salary to our lecturers. So we are going to need more money. We are going to need cash flow to purchase supplies, the markers that we use in the class, because we can't use the same marker in VI, we use the same thing in Solo. It's not the same thing. All right, so we are going to need more working capital. So when the size, if the size of the business is large, then the working capital required will also be large, and vice versa. So that's what we mean by the nature and size of the business. Okay. Again, when a company is expanding, or there's a business extension, when a company is expanding, more working capital will be needed. All right, more capital will be needed. That's another point you can consider. Then inflation. During the period of inflation, the purchasing power of money will fall. What that means is that the company will need more working capital to be able to run the business effectively. So when there's inflation, more working capital will be needed. All right. Then the next one is seasonality. There's a seasonality, what we call seasonal variation. There's a particular period in the year that customers do buy some products, okay, more often relative to any other period in a year. So as a manufacturer, for example, when you are getting closer to the festive period, the company will need to produce as many products as possible so that customers can buy for the festive period. So relative to other period like January in the year, like January, February, where there's nothing like a festivity that will enable customers to rush the company's product. So during that period, that's during that peak period that you think, like for example, Christmas, when Christmas is approaching, those manufacturing companies will want to produce as many goods as possible. During that period, they are going to need more of working capital for their production. All right, relative to other period in the year, whereby the sales is not as high as during the festive period. So that's what we mean by the seasonality. Then the last one is economic condition. All right, during the period, during the boom, when the economic is boom, when there's a boom in the economy, of course, customer will always be buying products. Customer will be, because there is money to spend, and that's why we call it boom. So customer will be they are ready to buy things to their spending ability or spending capacity will increase during that period. So the more the customers are buying, the more manufacturer will also be producing. So when manufacturers are producing, they are going to need working capital to buy materials and do other things. Okay, but when the economy is contracts, okay, when the economic is when we have a recession, of course, there is not much money in circulation. Therefore, little working capital will be needed because the company will not be producing, they will not be producing as much as they can because customers are not buying. That's everybody is just managing. There's austerity in town. Everybody is just managing, so they can't buy as much as as much as they want as far as the product is concerned. So the economic condition will determine the amount of working capital required. So when there is boom, more working capital will be needed because customer will they want to purchase more of the product. When there's recession or the economic contraction, then of course little working capital will be needed, okay, to purchase raw material and run the affairs of the business. All right. So these are some of the factors you need to consider in relation to working capital requirements. The number B part of the question, let me see. In the B part of the question, so you are told to calculate, you are required to calculate, sorry, let me go back. So you are required to calculate the sales to working capital ratio. So I will then come back here. Number B, Roman figure 1. We want to calculate sales to working capital ratio or working capital turnover ratio. So I will then come here sales to working capital ratio. This is calculated as sales divided by working capital. So examiner did not tell us. We are not given anything like sales return or discount in the question, so you ignore. All right. So you want to know how many times does sales cover working capital? All right. So I will then come here. I will go back to the question. How much is sales? How much is sales value?
11 million.
Sales value is 168 million. Sales is 168 million
Oh.
over the working capital. So working capital is not given. We need to go and calculate it. And working capital is current assets. Okay. So working capital. What's wrong with you? Okay. So working capital equal to current assets minus current liability. All right. So I would then say working, according to the question, how much is current assets? How much is current assets? Current assets is 53,640. 53640. In this 53640, you also have cash. Remember, when you say working capital, we say working capital is the amount required for the day-to-day running of a business. When you have cash, you want to calculate working capital. Once you have cash, you need to exclude the cash. You want to determine how many you want to calculate your working capital. You already have cash, so you exclude cash. So I can say 53,640 minus cash of 40,000. Remember, figures are in million. So you have to be very careful so that you don't give what belongs to you. You don't make a mistake. So let's use million. Since our sales is in million, so minus 40 million cash. All right. So this will give us current assets. That's current asset we are looking for first. So this will give us 53,600. But at this level, if you use 53,640, examiner will mark it for you. But what we are saying is that when you are calculating working capital, you don't include cash. You don't include cash because the cash is what you are looking for. You already have it there. So just you exclude it in your working capital. All right. Then current liability, according to the question, I think that's 10,080,000. Let me confirm. Yes, 10,080,000 is the current liability.
Sorry, sir. 53. Hello, sir.
Yes, go ahead. Go ahead now. You're asking, you wanted to say something.
Yes, you wrote 53,640 million. 53,640,000 minus 40 million is equals to 53,600. So I'm kind of confused.
How much is cash?
Cash is
Is it cash?
40,000, not 40 million.
Oh, I thought the figures are in thousand. Let me see. Oh, sorry. The figures is absolute number. Thank you. This is supposed to be, yeah, this is supposed to be 40,000. Thank you. So my working capital now, the working capital will then be equal to current asset, which is 53,600 minus 10,080. All right. So this will give us what? What's the difference? 43 what? Yeah. Working capital equal to 43. Let me use my calculator. 53,600.
43,020,000.
43,020,000. Did you say 20,000?
Yes, sir.
Okay.
43,520,000.
520. 43,520,000. So that's the working capital. So I will then come here. 43,520,000. So this will give us 168 million over 43,520,000 equal. That's ratio 3.9. This is 3.9 to 1. 3.9 to 1. So which means that sales can cover working capital almost 4 times. All right. So the average, your working capital turnover ratio will depend on the industry average. With this, we can't say whether it is ideal or not until you're able to compare with the industry standard. However, a ratio of 3 a ratio of 3 to 1 is assumed to be ideal. If your sales can cover your working capital like 3 times, that means it's an ideal. It's an ideal ratio. But if it is more than 3 times, that would be too excessive. For example, if you have like 5 to 1, so that means the company is not generating, the company is having a liquidity problem. That means your working capital is not sufficient enough to support sales. Your working capital is not enough to support sales. If the ratio is low, if your working capital turnover ratio is low, it means that the company is over investing. It may mean that the company is over investing in working capital, or the company is not generating sufficient sales. All right, it's not generating sufficient sales to run the business. All right, so in that case, the company may need to engage in aggressive marketing. But again, this is ratio 3.92 to 1. All right, then this next one, number B high, is the current ratio. I think, yeah, current ratio. So current ratio is current assets over current liability. All right. So current assets is how much is current assets in the question? That's 53,640. 53,640,000 divided by current liability of 10 million and 80,000. So this will give us ratio 5 to 1. Let me confirm. 53,640 divided by 10,080. That's ratio 5.3 to 1. 5.3 to 1. Again, this is excessive. This is excessive. The company is over investing. This is what we call under trading. There's so much current asset with little current liability. All right, this is not good. This is not a good working capital management. Okay, this is too excessive. Ratio 5 to 1 is too excessive. Yes, okay, what's your question?
I just wanted to ask that the first one we did, sales over working capital, under the
Yeah,
current asset, we excluded the cash, but here we added it.
this is current asset over current. In that one, you calculated working capital. I said when you are calculating working capital, when you say working capital, we said working capital is the amount required for the day-to-day running of a business, isn't it? So that's your current that's your working capital. So when you have cash, so you don't include when you are determining working capital, you have to exclude cash because that is what you are looking for. So you have seen part of the working capital you are looking for. You keep cash somewhere. All right. So when you want to calculate your working capital, when you have cash, you exclude it. You don't include it in your working capital. But this is current assets over current liability. Add up all the current assets, irrespective of whether you have cash or not. Add them together, then divide it with the current liability. So that's that. Then the next one
Sorry, sir.
is who's speaking?
Yes, sir, it's David, sir. So I don't understand the explanation. I wanted to actually ask why we removed that cash, but I don't understand the explanation.
The explanation I gave to Oge now, you still don't get it.
No, sir.
Okay. What I'm saying is that when you say working capital, you say working capital is the amount required for the day-to-day running of a business. You are looking for how much you need to run the day-to-day running of a business. Out of that amount, you can see cash, you have cash somewhere. So you are not going to add cash to the cash you are looking. So you keep the cash that you need, the cash that you already have, you keep it, you exclude it. How much do you then need? let's say, for example, you need working capital of 1,000 naira. You need working capital of 1,000 naira. In your balance sheet, you already have a cash. You already have a cash of 100. Are you going to add the 100 to the working capital of 1,000 that you need? No. So because this 100 is part of the 1,000 that you are looking for. Therefore, to now know the working capital you are going to need, 1,000 minus 100, that means only 900 is the working capital that you need to run the business because you already have cash. So whenever you are calculating working capital, you need to exclude cash. Okay? Let's move on. The next one is quick ratio or acid test. Quick ratio or acid test is the same thing. So just use only one, quick ratio. Okay, so the quick ratio or liquid ratio makes use of the most liquid assets. So like I explained earlier today, inventory is not part of a liquid asset because inventory can last longer for the company to convert the inventory to sales. So inventory cannot easily be sold, so it will take time. Therefore, when you are calculating your quick ratio, you need to exclude inventory. So I will then come here current assets less stocks. Examiner give us stock, not inventory. Let me confirm. Yeah, you are given stocks. Yes, stock of raw material. So of 21,600,000, then over current liability. So in this case, here will be 53,640,000 minus stocks of 21,600,000. Okay, so this will give you divided by current liability of 10,080,000. So we have 53,640, 53,640, 53,640 minus 21,600. So that will give us 32,040,000, 32,040,000 divided by liability 10,80,000. So this will give us ratio 3 divided by 10,080. That's ratio 3.2. Ratio 3.2 to 1. Okay. Ideally, your quick ratio should not be more than 2. Right? Ideally, your quick ratio should not be more than 2. When you have more than that, that means that's over investment in the current assets. That means the company is under trading. All right. And the last one, number 4, you have to determine operating cycle, right? You have to determine operating cycle. Let me see. Yes, operating cycle for the working capital. So number 4, we want to calculate operating cycle, which should be expressed in days. So I will then go back to the question, what are the components of operating cycle that are present in this question? In the question, you will have raw material, we have debtors, we don't have work in progress, we don't have finished goods. So we only have 3 line items. We also have creditors. Therefore, we need to go and calculate number of days, raw material is held in store. Then also, we are given debtors. So we calculate number of days credit is given to customer. So this will give us the gross operating cycle. Gross operating cycle, then you less number of days. Number of days credits is taken from supplier. Okay, so let's go and do working for each of them. All right. The first one is raw material conversion period. Workings. Working number one, raw material conversion period, which is raw material divided by purchases. So again, in the question, examiner did not tell us number of days in a year. We are not told to use either 365 or 360 days. So you are at liberty to use any one if you are not told. So multiply by 365 days. So in this case, raw material in the question, stock of raw material is 21,600,000 divided by purchases. Purchases is 105,120,000 multiplied by 365 days. Give it to me. What you get?
75.
75 days. 75 days. So it takes the company to convert raw material to work in progress. It takes the company 75 days to convert raw material to work in progress. Then, number two, we have debtors collection period or debtors conversion period, which is debtors over credit sales. Debtors over credit sales multiplied by 365 days. Okay. So according to the question, how much is debtor or receivable? Debtor is 32 million. So here is 32 million over. So credit sales is 168 million multiplied by 365 days. Give it to me. What do you have?
70 days.
70 days. Then the last one is creditors payment period. Number of days credit is taken from suppliers. So in this case, it is creditors divided by credit purchase. Credit purchases multiplied by 365 days. So according to the question, creditors is 10,080,000. Then you divide it with credit purchases of 105, 120,000 multiplied by 365 days. Give it to me. What do you have?
35 days.
35 days. 35 days. So that's that. So let's go and post 75, 70, then minus 35. So here will be 75, 70. When you add the two together, 145 minus 35. That will give us 110 days. So this represents the net operating cycle. So it takes this company 110 days to convert raw material back to cash. The length of time between when cash is paid to acquire raw material and when cash is finally received. So like I said, the longer the cycle, the longer capital is tying up without yielding any return. All right. And you need to try as much as possible as a responsible organization. You must strive to reduce the cycle. Okay. So that is the question. That is the question. When you go to the Golden Book, you can read more. There are several examples on operating cycle. So we still have about 20 minutes more. So let's spend that 20 minutes to talk about other areas of the scope of working capital management. Let's talk about overcapitalization, undercapitalization. All right. Then any other thing we may need to touch. So let's talk about that. So in our next class, we'll move straight to discussing inventory management or inventory control. Okay. So let me stop sharing this and move to the study material. Let me see. I want to see. So in our next class, we are going to inventory because the time we have now will not be sufficient to discuss inventory then to solve questions. Now let's talk about, let me see first. Let's talk about overcapitalization because this is examinable. This is examinable. What do you mean by overcapitalization? Overcapitalization is also known as under trading. Okay, it's also known as under trading. When a company is trying to do too much too quickly, all right. When you talk about over trading, okay, let's start with over trading. All right. So when a company is trying to do too much too quickly with little or no capital, the company is said to be over trading. For example, as a company, even though you are making sales, your business is doing well, but because you don't have sufficient working capital to run the business judiciously, all right, you rely so much on bank loan and overdrafts. You rely so much on credits from the suppliers to run your business. You don't have your own money. So when this happens, this can, at a point in time, you can experience difficulty to run the business effectively. And that's why you need to consider whenever a company is over trading, when you are trying to do too much too quickly with little or no capital, then it means that the company is over trading. All right. So it represents a financial situation whereby a company attempts to conduct a larger volume of trade than it is financially equipped to do. You don't have you don't have your own money. You can imagine you don't have your own money to run the affairs of the business. You are relying on a bank facility. So if your bank stop giving you credit facility, that means it will affect your operation. If if your suppliers do not give you credits for the material that you need for production, certainly it will disrupt your production. And this is what we are talking about. So you have to move according to your your size and capacity. Don't move too much. Don't move faster than your shadow. So when you are trying to do too much too quickly, all right, even though you are making sales, you are making profit, but because you are not liquid, so that may affect your operation. So because cash flow is the lifeblood of any business. If you don't have cash, of course, that will impair your ability to run the business profitably. When you don't have the car, you want to pay salary. For example, you want to pay salary, there is no money. Then you need to go and borrow. You need to go and borrow from your banks for you to be able to pay salary, which is not good. This is what Nigeria was experiencing before now, such that all the revenue being generated in the country is being used to service debt. About over 90% is being used to service debt. Then Nigeria Nigeria government was still borrowing again to go and pay salary. You borrow money to pay salary because you are not liquid, no cash flow. All right. So you can imagine the level of challenge. You can imagine the high level of challenges we are facing before now, because so much of the revenue being generated is being used to service debt. You are paying subsidy and all of that. So cash flow is very key. Even you as an individual, if you don't have cash, the life will be somehow. Like you want to go out, you don't have money for transport. You want to eat, no money to buy food. Oh, I like this dress. You don't have money to buy. You can imagine the like of the kind of life that one will be living if you are facing such a challenge. So this is what we are saying. Cash is the lifeblood of any thriving business. So effective and efficient management of working capital investment is essential to maintain control of business cash flow. So you need to manage your working capital efficiently to ensure that you are liquid enough. All right. So again, management must have full awareness of the profitability versus the liquidity trade-off. There is difference between profitability and liquidity. A company may be profitable without being liquid. Yes, because to arrive at your profits, you may borrow money, you may borrow loan to run the business. You may get your goods on credit to make sales. Once you make sales, then you return the money to your supplier. So it's different from you being liquid. All right. So your liquidity is its ability to have sufficient cash flow to run the day-to-day activity of the business and to also settle short-term debt obligation when the need arises. So when you want to pay salary, you have money to pay. You want to buy inventory and supplies, you have money to acquire that. You want to pay debt, you have money to pay. That is liquidity. But when you don't have any of this, that will become a challenge as a business. Therefore, the company the lack of liquidity, or when a company is over trading, the company can run into a serious trouble for the business. The company can run into serious trouble because the company is unable to pay its business creditors. You are unable to pay you are unable to settle the debt as and when due. You can't pay salary. So that's a very big problem. You see, when it comes, for example, you as an employee, if your company does not pay you salary the first month, the second month, the third month, you begin to grumble now. You should be looking elsewhere. It's like, oh, this company is having challenges. Let me find my way before it's too late. Yeah, because if a company is owing you, any company that is delaying you salary for more than 1 month, then there's an issue somewhere. You see that there's somebody at the top using your money to invest and getting return. That's why they are delaying your money. Yes, that's why they are delaying your salary, because I see no reason why you are going to work for 30 months, 30 days in a month, and you don't get your money on the due date. So that means the company has invested your money somewhere to generate return before they return it back to you. So any company that is owing you for more than 2 months, then that company is facing challenges. It's either they don't have sufficient cash flow to pay salary, or they are investing the money somewhere and they are expecting once they've earned the return, then they return back the money they have borrowed from the business. Anything can happen within any organization. We know how things are being run. So, all right. So that's what you under that's all that's what is known as the over trading. What are the symptoms? What are the symptoms you can see in a business to say a company is over trading? One of the symptoms is low liquidity. Remember, we said liquidity is the ability to have sufficient cash flow to run the affairs of the business and to settle short-term obligation. You need money. You have money to use. That is liquidity. But when you have a low liquidity, that's a sign for you that you are over trading. When you have liquidity, a low liquidity ratio, it's a sign of over trading. All right. Then the second one is rapid growth in current asset and current liability. So when you are over trading, so that means you have rapid growth in current asset and current liability. So when this happens, because you are just when you borrow, you go and buy asset and all of that. So you just see that your current assets will be growing. Your current assets will be growing. Then again, uh, let me just mention one more. Creditors payment period is getting longer because you don't have money to settle. You don't have money to pay your suppliers. So that means you are going to delay. You are going to delay payment to your suppliers, which of course, as you know, this can impair your credit worthiness to the supplier. The supplier will not look at you in a good manner because you are delaying payment to your supplier. That's not a good thing. This can erode the reputation of the company. When you are delaying payment to your supplier, it can erode your reputation going forward. For some of you that are still owing us, we have marked your face. We've marked your face. Next time, if you come to us that, okay, CEO, please, this is what I have now. I'm going to pay the balance. And then even in the next few days, we will not allow you because we know that you are not credit worthy. If you have delayed payments since July to date, and you are keep on promising us that, oh, please give me to the end of July, I will balance up. July come, we'll send you a reminder. You refuse to pay. Okay, it's our student. He's still there or she's still there. August, September, you are still here to balance up. How much less than 100,000 naira lecture fee you are paying in instrumentally? It's allowed, we allow you, but yet you refuse to pay. And some of you will now come back to us to tell us that because I've not been around for a while, so I don't want to do this subject again. Who told you that? You cannot defer because the instruction is there that after 2 weeks of lecture, you cannot defer. Then you now refuse to pay. So if we now begin to, you can see. Anyway, don't let me digress because the thing they annoy me seriously because I can't imagine with all our efforts, some people will still be owing us lecture fee at this moment. It's not good now. In other tuition said that they don't allow that. If after 2 weeks we don't pay, you can't enter the class. But because we are kind of okay, lecture first. Lecture first. This student will pay. No worry. The student will pay. Lecture first. Let them gain. Let them gain the knowledge. Let them receive the class, the lectures, so they can pay. Anyways, let's move on. The next one is overdraft. Because you are over trading from time to time, you go to your banks, to your bank to say, please, I need overdraft facility. Each time, maybe you are given overdraft facility of 200K. Each time you are even exceeding the overdraft limits. All right. So because you don't have sufficient working capital to run your business, from time to time, almost every time you are exceeding the overdraft facility. Then when you are having this kind of a challenge, that means you are over trading. You need to work, you need to improve on your liquidity position. Don't do too much. Don't do too much. You don't do beyond what your capacity can undertake. Grow organically. If you want to borrow, yes, make sure that it's on investment that you know that it has a specific period when you are going to recoup your investment and hence your return on your investment. All right. So don't put too much pressure on yourself as a business because you want to be like Dangote, right? Before you know, you run into trouble. The banks that you are rushing to every time, even the mortgage microfinance bank you are rushing to, they too will be praying that you won't have the capacity to pay back again. you know so please just grow according to your size. Don't overburden yourself. All right, that doesn't mean that if you have good investment that you need money for, yes, you can go all out because most of all these big companies you are seeing here too, they like Dangote, all of them, most of them they live on people's money. It's not that they don't invest their own money, it's the loan they borrow from the banks that they invest. So once they make the return, then they pay back the loan. That's how it works. You don't use your own personal money to invest. You use people's money. That is, if you know people in high places that where you can get the loan. All right. So you can read more to cover. You can read more to cover that. Let's talk about the last one. The under trading, under trading or overcapitalization. All right. So let's talk about under trading or overcapitalization. All right. So what do you mean by overcapitalization? It is a situation whereby a business is financially equipped. This is just opposite of undercapitalization. So the overcapitalization is a situation whereby a company is financially equipped to conduct a larger volume of activities than necessary. So in this case, you have so much heavy current assets with little current liability. So you are over invest, you have excessive working capital, excessive current assets. So when this happens, it means that the company is overcapitalized. The company is overcapitalized. When you have excessive current asset like like inventories, account receivable, and cash. So all these investments would have put it in the short-term marketable security to generate additional revenue, additional returns to the business. But you have so much inventory, and you know that inventory is not a moving kind of asset. It will take time for you to convert the inventory to sales. So customers are paying you. You don't bother because you have so much investment in your current asset. Customers are paying you. That's receivables. You have large receivables. The cash is just lying there in the bank, yielding nothing. The cash should have invested in short-term marketable security like a treasury bill, federal government bond for 3 months, 6 months, even 180 days. All right, 180 days or 270 days or 1 year maximum to earn additional return. You are just keeping the money in the bank. The thing is swelling in the bank because you don't know what to use it for. This is not a good way to manage your working capital. You need to avoid that. Even as an individual, when you have cash, when you have saving in your savings account, you have so much balances in your savings account. For example, at a minimum, even when you have a million naira in your savings account, you shouldn't keep it there. You are supposed to invest because all you need to do is to make a call through to your account officer to find out when is the next cycle for your treasury bill. Even if it's only 1 naira additional, if it's only 1 naira you earn on that investment, it is something. It is viable. If it is additional 1 naira you earn on that your invest, instead of when you keep it in the bank, it's not yielding anything at the end of the month. If you don't touch your bank, your bank balance, your bank will just give you something. Okay, you to take this one, maybe 0.5% or 0.25% interest on whatever you keep in your savings account without touching it in a month. But you can invest that money in a treasury bill. Just send an email to your account officer. See, when is the next cycle? Once you know, let's say for example, the next cycle for the treasury bill is next week. So you could have just send an instruction. Please invest 1 million, debit this account and debit this account with 1 million naira and invest the same in a treasury bill, blah blah blah. So you give that instruction to your account officer. So when the cycle is around, then they will invest on your behalf. Then they will give you the return almost immediately. Once you invest that money, whatever the returns, the yield, you are going to get it immediately on that day. So at the when the tenure expire, maybe it's for 3 months, so you are going to get your principal back. The cash the amount you have invested, you are going to get it back from your treasury bill. So the treasury bill is secure. You can't lose money. The risk is very low, but the return is also very low. All right. You can also invest in the bankers commercial papers, bankers acceptance, all those things. They are short-term securities that you can put your money on. Okay, so that is for that. So when you talk about overcapitalization, the company has excessive inventory, accounts receivable, and cash, and very few accounts payables. All right, very few account pay because you can't hold when you have excessive current asset, you can't hold your supplier because you have the cash to pay. You are not holding anybody, which is not good as a business concern. So there will be over investments in the current assets. When you have excessive current assets, that means you are over investing in current assets. So that is what is known as over capitalization or under trading. What are the symptoms? What are the symptoms? One of the symptoms that you are going to see, the sign you are going to see in a business is high turnover ratio, low return on capital, low return on capital because you have so much, your assets is huge. Your assets is huge, and if you don't use that asset to generate sufficient sales, certainly you are going to have low return on capital. Then you are going to high current ratio because you have excessive current assets with little current liability. With little current liability, that means you are going to have excessive current ratio or high current ratio. So these are some of the symptoms of uh, overcapitalization. These are the symptoms of overcapitalization. I think that's okay. So in our next class, we are moving to inventory management. We have talked about this today, determinants of working capital. So we have talked about this today. So you can just read more. If you have the golden book, the explanation of all of this are there, so you can read it through. Okay? It's not just when examiner is asking you to list the determinant of working capital, not that you just do like you have in this material, business environment, nature and size of business, price level change. What do you mean by business environment? What do you mean by nature and size? You have to explain each of them for you to be able to earn your full mark. You can't just do this and expect to earn full mark. I will just give you half. If I'm the one marking your scripts, I'll just give you half, half, half. I can't give you full mark under each of them because you need to tell me when I say determinants of working capital or factors of working capital, you can't just give me this and I will mark you full. No, it's not possible. I can't give you full mark. You need to explain to me what do you mean by growth and expansion. All right. So please watch out for all of this. This will be the end of the class. Like I said, in our next class, by the grace of God, we are moving to inventory inventory management. So we meet on Monday by the grace of God to discuss this. All right. So under this, we introduce you to inventory, the meaning of inventory management. All right. What are the objectives of inventory management? What are the reasons for holding inventory? What do you understand by inventory cost? Okay. What is economic order quantity? EOQ, how do you compute economic under quantity? What are the underlying assumptions of EOQ? So once we are done with that, we have illustration that will move to inventory levels. All right, the maximum stock level, minimum stock level, reorder level, average stock level, stock turnover level. All of this, we discuss it under inventory management. So by the grace of God, in our next class, that is what we are going to do. Finally, let me know if you have any question for me before we close the class. Any question for me? Adal is still on in the class. I can see David. David is still on. Esther, Babalola, Ruth, Glory, right? Glory is still on. Home care. Home care. You have not taken care of my home care. Since that is the service that you render. You need to come and take care of my home. Hmm? Then Laura is still on. Mary, Idoko, Moses. Moses, are you in this class or you are attending by proxy? I've not heard your voice. Yeah, I'm very sure Moses is attending by proxy. If he's in the class, he would have talked. Then Ogechi is on. Yeah, I see Samias. Samia, you are so quiet tonight. These two ladies, Kemi, Olukemi, and Angela, they've been missing classes. Ahmed, you just joined back.
I've never left, so I've been on
Uh,
online since.
Okay.
I'm fully on ground.
It's all right. So, guys, thank you very much for joining the class. We
Thank
meet
you so
again
much, sir.
next week by the grace of God.
Sir,
Good night.
sir, please, is the
Yes,
class
Good
on
night, sir.
Monday or Tuesday?
on Monday. Sorry,
Monday,
Tuesday.
Tuesday.
Tuesday. Yeah. Thank
Have a
you.
swag on
Hello,
Monday.
sir.
Yes,
Hello, sir.
yes. Yes, talk to me.
Sir, you mentioned Monday. Is the class
It's on
now?
it's on Tuesday.
Uh-huh.
It's on Tuesday. It was a slip of tongue. It's on Tuesday. Okay.
Good night.
Yeah, good night, everyone.